Lesson 6, Buy and Sell Zones. Before we get started, I'd like to point out a couple things. As you go through your workbook, you'll notice that in the bottom center of each slide, there is a number. That number is the number of that slide. That number corresponds with the number in this presentation. If by chance you lose your place, just find out what slide I am on and match it up with the slide in your workbook, and you should be caught up with where we're at. The other thing is, I'd like to point out this sign here. This sign will appear during this presentation. On that page, whenever you see this sign, there will be a trader's tip or some very important information that you need to know, perhaps memorize, that can play a big part in helping you trade in the markets. There are 16 lessons on trading the Forex that can help you. These lessons focus in on technical analysis. Not only are they applicable to the Forex, they're also applicable to many other financial markets. Successful traders will do what unsuccessful traders can't do and won't do. I cannot overemphasize this. Think about it for a second. What's the difference between you and a successful trader? You both have two legs, two arms, two eyes. You see, you hear, you think. The only difference, perhaps, is what one knows and can do that you can't do. I've found that mentorship, education is very important to the success of a trader. It makes the difference between a successful trader and an unsuccessful trader. Discipline of that information and knowledge participates in your success. The 21-day 3% rule, which basically says the human mind forgets 80% of the knowledge it acquires within 3 days. If you listen to this CD or this lesson and you forget about it, you don't review it, if you don't use it, you'll lose it. You'll lose 80% of the information within 3 days of what you're learning here. Over the next 18 days, it will continue the loss of information until it settles at retaining only 3% of the original acquired information. Our focus here at Market Traders and Forex Tips is to help you have 85 to 95% recall of what's going on in the market so that you have a fighting chance at being successful as a trader. By the end of this lesson, you should understand that the markets can only move up, down, or sideways. You'll be introduced to the technical side of dealing with a trend and a trend line break. You'll learn what the buy and sell zones are. You will learn how to find a trade in the buy zone or the sell zone and create a trading plan. You will learn to trade that plan and financially protect yourself in every trade. To help you in this lesson, I'd like to review Lesson 1, which is placing your orders. We use Japanese candlesticks. They're more user-friendly. Lesson 11 really focuses in on some great trading techniques with Japanese candlesticks. We look at a bid chart. That is the bid price. Most traders watch a bid chart. There is the bid and the ask. The ask is always a little higher depending on what product you're trading. In the currencies, the ask chart will it be anywhere from 3 to 10 pips higher than the bid chart. It will look identical to the bid chart, just be a tab higher. As a trader, you buy on the ask and you sell on the bid. This is very important information. Here's that sign. You buy on the ask, sell on the bid, which means if you jump in the market and you're buying, this is the bid price. You do not buy on the bid price, you buy on the ask price, which means if this is the bid price, 107.30, these are your pips, the ask price would be 107.35. Once you place an order, you're going to learn to have, when you place a buy, you're going to learn to have two sells, one for a protective loss stop, one for a limit profit to get out. Whenever you have a buy, your two sells will be on the bid, which means if the market rallies, predominantly when the candle hits it, that's when the market hits your price because you sell on the bid. Conversely, when you enter the market selling, you are selling on the bid, which means that would be the price. If we entered the market right now, we would get 107.30. Every sell needs to have two buys. If you should have a buy for profit and a buy for potential loss. We buy on the ask, which means the ask price is 3 to 10 pips higher depending on the currency you're trading. If the market were to rally up here and your stop order is up here, then the ask price is going to hit it before the bid price will, which means if the bid price never hits your ask price, your buy stop, you still will be stopped out, because if the ask hits it, then your order will be filled and you will have been stopped out. So keep that in mind. A lot of traders have difficulty sometimes remembering that we sell on the bid and we buy on the ask. Types of orders. A market order, if you want to understand your orders real well, lesson 1 once again focuses in on the types of orders. The market order is whatever the market is. There's a bid and the ask, that's the market. A limit order is an order that is placed at a specified price that you will be filled at that price or better, and a stop order is an order that turns into a market order when touched. Once again, here's the market. That would be the bid price, 107.30. Any order placed above this price, 107.30, anything placed above that would be called a working order, an open order. When you buy above the market, that order is called a stop order. When you sell above the market, that order is called a limit order. So if you placed a buy at 109, it's above the market, that is a buy stop order. If you placed an order to sell at 109, that is called a sell limit order. Those are the rules. This is something you'll just have to memorize. It's really not that difficult. Usually you'll have it down the second day you start playing around with your software. Any order that's placed below the market, any order placed below this price is called an open order, a working order. When you buy below the market, that's called a limit order. When you sell below the market, that's called a stop order. Those are the rules. Here's another rule. Every time you buy, you should have two sells. A sell for potential loss and a sell for profit. Even if you are canceling, replacing, and chasing the market, have a wish list price, if you will. Place an order way out there just in case the market really rallies overnight or whatever, depending on how long you're staying in. But have a specified, what I call a lotto wish list trade, just in case the market, something happens and the market spikes up there and fills you, if you're canceling or replacing, that you'd be satisfied with. Once again, if you entered the market here on a buy, your stop order goes at the last low or where support is. Have a wish list way up here, many pips away, just in case the market takes off. You should have a limit exit order for profit. Every buy needs two sells. Conversely, every sell needs two buys. Whenever you're shorting the market, you're wanting it to go down, you're bear, your position is short, you will have a buy for profit and a buy for loss. Let's look at this chart. You enter the sell zone, which we'll be discussing today. You sell here, your stop goes at the last high. Every sell needs two buys. Here is your buy stop, and here's your buy limit. Once again, you may want to put in what I call a wish list order, and for large amounts of profit. OCO. An OCO is an order where you enter the market and you place a limit order at a specified price for profit, a stop order for potential loss. You set those numbers, you set it and forget it. The market will either do one of three things when you come back. You'll still be in. That would be option number one. Option number two is that the market would have rallied and paid you off here. If it rallies and pays you off here, it will cancel the stop order. That's what an OCO means. One cancels the other. If it hits that first, it cancels the stop order. If it hits your stop order, that's the third scenario, you will lose, and it will cancel your limit profit order, so you don't have a working order in the market. Canceling and replacing. Great information in lesson 16 and in lesson 3 on canceling and replacing. Remember, only cancel and replace to the new last low after the market has made a new high. Let's look at this. We enter here, market rallies, we lock in profit. As the market rallies and retraces a little bit and bounces, makes a new high, we'll move our stop order from here, this low, to now this low. Market makes a new high, retraces back, bounces. As the market is rallying here, taking out the old high, then we cancel and replace our stop from these lows to these lows. Market retraces back, bounces, U-turns, takes out the previous high. We cancel, replace to the new low. Cancel and replacing is not a greedy way to trade. It is an educated way to trade. The exact opposite takes place when you cancel and replace in a dipping or reacting bearish market. Only cancel and replace to the new last high after the market has made a new low. Let's just say your stop order is here, market dips down, it finally stops, creates a low, retraces a little bit, U-turns. Now at this time right here is when you are going to want to cancel and replace to the new last high or level of resistance. So that is very critical here. Bulls want the market to go up. Bulls buy low and sell high. They buy low and sell high. Here's an indicator trading, which is lesson number 4. Plays a big part in helping traders find comfort in their numbers. Indicators can give off buy and sell signals. Be that as it may, bulls want to buy low and sell high. They enter the market buying first, selling second. These 3 moves equated to 290 pips in profit. 1 lot is 2,900. 10 lots would be 29,000. Currency trading can be very profitable. Bears, they want to sell high first and then buy low later. When you sell first and buy second, you short the market. Even if you sell first and buy second, you still buy low and sell high. Look at how we sell first and buy second, but we still bought low. We bought it at 104 and sold it at 107. So the greatest part about currency trading is whether the market is going up, you can make money, and if it's coming down, you can make money. If you have any difficulty in learning to short the market, please give our company a call. We'll walk you through what it means to short the market. Technical traders learn to read charts. That's what this lesson is all about. Technical traders read charts like doctors read x-rays. To the trained eye, charts are telling a story. Technical analysis gives the trader a high probability of knowing where the market is going. We don't make any money from past movement unless we are already in the market. When it's time to trade, we have to somewhat predict the future. We have to predict what the market's going to do. Technical analysis teaches us that the market will have a high probability of moving in a direction. That's the value of learning technical analysis. Because a chart is a chart is a chart, once you learn technical analysis, it'll play a big part in teaching you how to control all your finances, where you can pull up a trading chart. You can pull up trading charts on stocks, options, commodities, currencies. It doesn't matter what the financial product is. A quick review on support and resistance will also be very helpful for this lesson. We are working off of Japanese candlesticks. Remember, highs are 2 candles to the left that are lower than either the body or the wick of a candle, and 2 candles to the right that are lower. That constitutes a high. Here's that important information again. Remember, not all highs are levels of resistance. Only higher highs that are being created become new levels of resistance from where the market is currently being traded. Lows, 2 candles to the left and 2 candles to the right that are higher than the wick low or the body of the candle low becomes a low. There's that important sign again. Not all lows are levels of support. Only lower lows that are being created become new levels of support from where the market is currently trading. Lesson 2 really focuses in on support and resistance. It's a very good lesson. But remember, whenever you turn on a chart, go find all your levels of resistance. Remember, you are stepping up a ladder on all your levels of resistance, and you are stepping down a ladder or steps on your levels of support. Go find all your levels of support and resistance before you trade. Do not over or underestimate the financial game here between the bulls and bears. Bulls are trying to make new highs and take out old levels of resistance. Bears are trying to make new lows and take out old levels of support. Another lesson, lesson 5, trends and trend lines, will be helpful for understanding the buy and sell zone, uptrends. All trends move within a swing move. Remember, the upswing starts at a low and goes to a high, retraces back. An uptrend is when the market is swinging, making higher highs and higher lows. This is an uptrend. Uptrend is making higher highs. This high is higher than that high, and this high is higher than that high, and higher lows. This low is higher than that low, and that low is higher than that low. That's an uptrend. When you spot an uptrend, you draw your trend lines across the lows. Lesson number 5 goes into detail about trends and trend lines. There's 3 different trend lines we're monitoring: the inner, the outer, and the long term. Lesson 5 teaches you how to do all that, but you draw your trend lines across all the lows of support. Here are the 3 inner, outer, and long-term trend lines once again. Downtrends work the same. There are downswings that start at a high and stop at a low. You can see the market is swinging down. Swing 1, swing 2, swing 3, swing 4, swing 5, until it decides to start to reverse. Market moves and swings. This is a downswing. A downtrend is when the market is swinging down. It is making lower highs. Look at how this high is lower than that high, and this high is lower than that high, and this high is lower than that high, and lower lows. This low is lower than that low, and this low is lower than that low. A downtrend is when the market is making lower highs and lower lows. When you spot a downtrend, you draw your trend line across the highs of resistance. Look at these highs. This is the outer trend line. Once again, there's 3 trend lines: inner, outer, and long-term trend line that you need to educate yourself on how to draw, which can become very helpful. Now let's get into the lesson. Lesson 6. Buy and sell zones. Before we get started, the best way to understand what you have learned is to write down what you think you know. Then go back after you have been taught and look at what you thought you knew versus what you now know. Your perception is your reality. My perception is my reality. Write down what you think about buy and sell zones. In other words, let's look at this chart. Why don't you find me a buy or a sell zone in this chart. Put this on pause as you do this. Here's a Japanese yen 4-hour chart. Buy and sell zones are in all time periods. Find the buy and sell zones in this 4-hour Japanese yen chart. You can place this on pause to do this exercise. Here is a Euro 1-hour chart. Find all the buy and sell zones in this 1-hour chart. Please put this on pause as you find the buy and sell zones. Buy and sell zones exist in stocks because a chart is a chart is a chart. Here's a Microsoft 2-hour. Find the buy and sell zones in this chart. Dell stock. Find me the buy and sell zones in this chart. Place the computer on pause as you work through this. Now, what goes up must come down, and what comes down must go up. As it's going up, it is trending. As it's going down, it can be trending. Our focus is trying to spot the end of an uptrend and the end of a downtrend. Buy and sell zones are exactly that, spotting the end of an uptrend and the end of a downtrend. Now, how do you spot the end of an uptrend? The uptrend ends when it bends. Prices first penetrate the trend line, then retrace back to the last low or latest level of support. That is how you spot the end of a trend. Look at this. The market was trending up. We drew our trend line across all the lows of support, and now the market bent. In other words, right after this high, it came down and hit the last level of support after it made a new high. Then it bent through the trend line. Spotting the end of a downtrend. The spotting the end of the downtrend is the exact opposite. Prices penetrate the trend line, then rally back to the last level of resistance. Let's look at this chart. The market was trending and waving down, making lower lows and lower highs until all of a sudden it bent the trend line after it made a new low. Look at how it bent the trend line here. But it did not do that after it made a new low. It has to bend after it either makes a new low or after it makes a new high. After it makes a new low, it bent and it came up to the last level of resistance. That is when you know you're at the end of a trend. Now, look at this chart. This chart has buy and sell signals on it. These buy and sell signals focused in on lesson 4 called trading indicators. They can also become very helpful. Look at after the market bent and retraced back up to the last level of resistance. This indicator gave a buy signal. Now, when the uptrend bends, prices penetrate the trend line and start to dip or retrace back to support. Now that the market dips, it'll enter into the sell zone. Everything south of the trend line on an uptrend is a sell zone. Let's look at this. When the market finally penetrated the trend line, all this area down here is called the sell zone. The market has now entered into the sell zone. Conversely, the absolute opposite takes place in a downtrend. When the market finally bends in a downtrend, it now enters into the buy zone. The buy zone is everything north of the trend line. Look at how the market bent right here. Everything north of this line then becomes the buy zone. Now, here's a trading exercise. Here's how you trade the buy zone. When the market enters into the buy zone, you wait until a complete bullish candle, wick and body, forms and clears the trend line on the north side of the trend line. Look at how wick, body, in its entirety, have cleared the trend line. They are now on the north side of the trend line. Let's take a closer look. Look at here is the trend line. Market was making lower lows and lower highs. The market bent a little bit here, but now a full-bodied candle. See how this one, the wick is still on the south side? A bullish candle needs to be on the north side in the buy zone. You wait until a complete bullish candle, wick and body, form on the north side of the trend line. Now you must wait until you have a completely closed candle. Do not enter the market just because a candle is breaking a support or resistance line. It could be a false spike. Look at this. We had a trend line here. If you would have entered the buy zone, this stayed in a downtrend. You must be very careful at this. This can really fake you out and end up losing a lot of money because of that. So you must wait until you have a complete bodied candle. Here's the trend line. We finally had a bullish candle, body and all. It looks like either here or here that cleared the trend line. Be that as it may, we're going to teach you how to trade it. Here then becomes a trading exercise that I'd like you to do. Can you find the bullish candles in the buy zone? Turn off your computer, or excuse me, put the computer on pause as you go through this exercise. Find the bullish candle in the buy zone. This is the candle. There is your candle in the buy zone. Now, can you find the bullish candles in the buy zone in this chart? Put your computer on pause as you do this exercise. That is the first bullish candle in the buy zone. Look at how the market completely turned around after the market entered into the buy zone. You had a major reversal. This is a lot of profit. Now let's look at equity management in the buy zone. A lot of times the market enters into the buy zone, but if you were to trade that, your stop would go to the last low. Now this lends itself to good equity management. You can see these are, let's say 50 pips. This would be good equity management, tight stops, to where this would not be good equity management. Look at, if you bought here, the market, this is perhaps 175 pips away to where your stop would be. Even though the market has entered in the buy zone, even though it did pay off, there is a better way to enter the market when your equity management is not in place. If you review lesson 8, which is the king's crowns and the reversals, there is a better entry that lends itself to equity management here. Whenever you come across a buy or sell zone where it is not good equity management, then trade a crown instead of a buy or sell zone. Now here's a trading exercise. Let's trade a buy zone. When the bullish candle enters the buy zone, place a market order to buy at the opening of the next candle if your equity management allows. Remember, the distance of the largest down move can equal the distance of the up move. For maximum profit taking, please refer to lesson 7, the Fibonacci's. Now look at this. This is a trader's tip. Many times in a downtrend, see the distance in this nice down move here will equal the distance of the up move after the trend line break. It doesn't happen 100% of the time. There's no such thing as 100% of the time or always in the market. There's just called high percentages or low percentages, or predominantly. Predominantly this happens. The distance between the largest down move will equal the distance of the largest up move after the trend line break. That is the trader's tip. Let's face the facts. Whenever we want to enter the market, we want the market to move in our direction from entry. Education on how the market works improves those percentages. Let's look at what educating ourselves about the sell zone and buy zone can do for us. Rules to trading the buy zone. Find and draw all your trend lines, your inner, outer, and long term. This will help you determine if you are in an uptrend or a downtrend, or if the trend line has been broken, signifying the potential end of a trend and reversal. Find the down trend line break and the bullish candle in the buy zone. Find where the last level of support is in the downtrend to determine where your protective stop loss order will go. If you can't afford the potential loss should the trade not work, then stay out and do not trade. Pull out your trader's checklist and create a trading plan and trade that plan. Turn on your trading software. We recommend that you practice trade before you enter with real money. Our trading software allows you to do that with Monopoly Money. Now let's trade this. The market enters the buy zone. You now have one complete bullish candle, which is this one, in the buy zone. Now that we have a completed bullish candle, wick and all, we are going to buy at the opening of the next candle. And we're going to enter the market at the market. You must wait until the market closes, or excuse me, until the candle closes before you enter into the market. We've provided you with a paper trading we've provided you with a document that helps you monitor your trade just in case the software crashes, just in case your computer crashes, just in case the electricity goes out. Handle all your trades and monitor everything you do on paper as a backup to show and to maintain a record of what you did. You'll notice how this piece of paper is only printed halfway through. That is so that after you enter the trade, you can print the top side of this. You can print the top of the chart and attach the two for your documents and for reference of what you've done. Let's look at this once again. We now have a trade. The market entered into the buy zone. Right here is where you had the clear candle. You bought at the market right here. You then placed a stop at the last low. Before you enter the market, decide whether or not you want to be a day trader or an overnight trader. Decide whether you're going to stay in just for a small amount of pips or whether you're going to stay in for 3 or 4 days, canceling and replacing. Either way, the rule is at the opening of the fourth candle, or excuse me, at the opening of the next candle after you have a clear bullish candle, will you buy with a stop at the last low. Remember, every buy needs to have 2 sells, stop order, and a limit order for profit. After you practice trade, fill out your paperwork, your P&L statement on your profit and loss so that you can see how much money you're making. Your software keeps track of that. If you want to know how to enter the market at a better price at the end of a trend, you must purchase lesson 8, the King's Crown, which is the end of the trend and the reversal. We're going to go through another trading exercise. Here's how you trade the sell zone. When the market enters the sell zone, you wait until a complete bearish candle, wick and body, forms and clears the trend line on the south side of the trend line. Look at how this candle, wick and all, cleared the trend line. Now let's look at here. Here's an actual chart. The trend has been bent. We finally have a cleared candle. It needs to be a bearish candle. This is now a bearish candle that is south of the trend line. We will then enter the market at the opening of the next candle. Here we go. Here's our first bearish candle. We enter the market at the opening of the next one, and look at how the market fell after that. Provided equity management is there for your trade. Now, can you find the bearish candles in the sell zone? Here's an exercise. Look at this chart, draw your trend lines, and find me the first bearish candle in the sell zone. Please put your computer on pause as you walk through this exercise. This is what it should look like. That is the first bearish candle in the sell zone. We would then enter the market selling right at the opening of this candle. This is the payoff if equity management allows. On this chart, can you find the bearish candles in the sell zone? Draw your trend lines. Put this computer on pause as you go through this exercise. That is the first candle in the sell zone. This then becomes our entry. From entry, look at how the market just fell. Now, let's look at equity management in the sell zone. On this trade, This trade lends itself to great equity management. Look at how the stop is only about 40 pips away. Once you enter the market, lends itself to great equity management. This one does not. This one, if we were to enter the market, here is your clear candle right here. We'd be entering the market right here because this is the first candle that clears the trend line, and we'd be shorting the market here. That means our stop would have to be almost 100 pips away. The risk is too great. When the risk is too great, go find another trade. Here's your first candle that clears the trend line. You'd be selling at the opening right at this next candle. This once again is about 90 pips. So unless that lands within your equity management, you may want to pass on the trade. If you want to know how to enter the market at a better price at the end of the trend, you must, once again, go review Lesson 8. Here's the trading exercise. Let's trade a sell zone. We're on slide number 102. So when the bearish candle enters the sell zone, wick and all, then we can enter the market. Once again, the distance of the largest up move can equal the distance of the down move. Look at this. Here's the uptrend. Look at the distance of this last move, how it equaled the distance of this new move. Now here's the largest upswing in this whole trend, but it seems as though on this one, the most recent distance equaled this distance. So the largest rally from the trend line bounce in the uptrend can equal the largest dip after the trend line break. Let's face the facts. Every trader wants the market to move in their direction from entry. Education on how the market works can improve our percentages. Look at what a little bit of education can do for us here. The rules are virtually the same, just in the opposite direction. Find and draw your trend lines, inner, outer, and long term. This will help you determine if you are in an uptrend, downtrend, or if a trend line has been broken, signifying the potential end of a trend or reversal. Find the uptrend line break and the bearish candle in the sell zone. Find where the last level of resistance is in the uptrend to determine where your protective stop loss order will go. If you can't afford the potential loss, should the trade not work out, then stay out and do not trade. Risk management is what this is all about. Pull out your trader's checklist and create a trading plan and trade that plan. Once again, activate your trading software before you trade. This is now a bearish candle in the sell zone. We now have a trade. You can do this on any time frame if equity management allows. You can trade trendline breaks on 15-minute charts, 30-minute charts, hour charts, 2 hour, 4 hours, provided equity management allows. Remember, you must obey the rules. We finally have a closed bearish candle, which is this one right here. We now want to short the market. You will fill out your paperwork as you trade. Lesson 2 focuses in on support and resistance. Do not underestimate the importance of this game. Once again, you will place your order here. Remember, every sell needs 2 buys. You'll place your arrow down here. You'll put your numbers here. We're trading the sell zone. Fill out your paperwork on your trader's sheet. Put your dates and the stock and currency that you're trading, whatever it is. Now look at, we entered right at the opening of this candle, and look at how the market took off right after. Then it settled down, went sideways, and then continued to fall. Learning to trade the buy and sell zone can be very profitable. Fill out all your P&L statements, print out the chart up at the top of the sheet, and file it in a notebook. It's very important you keep records of everything that you do. Now remember, when the inner trend line is broken, the market predominantly moves to the outer trend line. There's the inner trend line break, market breaks it and moves to the outer trend line. Here's a tip. Whenever you're monitoring the inner or outer trend line, always measure the distance between the inner and outer trend line. If there is not enough profit to be made between the inner trend line and the outer trend line break, you may want to stay out. Make sure there's ample distance between these two before you enter into a trade. Let's look at this one. Here's the inner trend line. It broke. Here's the outer trend line. Look at, there's ample distance here. These are 500 pips move. This is roughly a 200 pip move. The market breaks the sell zone. There's the first entry. Look at, here's all this profit. Remember, the same will take place when the market breaks a downward trend line. It'll probably work its way to the inner trend line. Look at how the market broke this inner trend line. Market enters into what's called the buy zone. Here's your first clear candle. You bought right here at opening. The market dipped a little bit, hit the back side of the trend line, which it usually does. You learn that in lesson 5 in trends and trend lines. And now it's going sideways, slowly working its way to the outer trend line. It is when the inner and the outer trend lines are broken that you are now going to get a major reversal. Look at how this inner trend line broke. It went to the outer trend line, it bounced, but then it U-turned and went through it. If you shorted the market on this, but yet it U-turned, you now have entered into the buy zone. This is the buy zone. There's your first clear candle in the buy zone. You would enter the market right at opening of this candle. Look at how this paid off quite handsomely for you. These are 500 pip moves. So the best way to understand what you have learned is to write down, remember that exercise at the beginning of this? Put this on pause and go back and look at what your perception was of what the buy and sell zone should be. And now let's walk through what you probably now see. Here is the Swiss franc. This is how your trend line should have been drawn, and now that is the sell zone. Here's the chart of the Japanese yen 4-hour chart. The market is still in an uptrend. It has not entered the sell zone. We are still trending up. Here's a Euro 1-hour chart. Look at all these buy and sell zones. Look at how the market trended up. It came into the sell zone after it broke the trend line. Then it trended up, came into the sell zone, trended up, sell zone. Yet you can see the waves, but this is really how the market works. We're in a downtrend overall, but there are small little sell zones and buy zones always taking place. We are now in the major buy zone at this trend line break. Microsoft 2-hour chart. Look at how we were trending down here. Then we entered into the buy zone, but then we went sideways until we hit the trend line. This was a long-term trend line right here. Market continued to fall. We entered only the buy zone for a short period of time. We are still in a downtrend. The market has not entered into the major buy zone for the major reversal. Here's Dell stock. Look at all these buy zones. Here became the first buy zone of the trend line breaks. Remember the market trends and that there are trends inside of trends. This is a downtrend. This is an uptrend. This is a downtrend. Small uptrend. This is a downtrend. Trends inside of trends. We are in an overall downward trend, but there's lots of trading opportunities in understanding how the buy and sell zone works. Once again, here's your rules to trading the buy zone. Read them, understand them, memorize them. Here's your rules to trading the sell zone. Read them, understand them, have them become a part of your methodology. Let's all agree, if you're going to learn how to be a successful trader, you've got to have an edge. You've got to educate yourself on how the market works and where to get in and where to get out and understand the whys. You need to learn how the buy and sell zones work so you can make money off of them. Buy and sell zones can be very profitable, and you must manage your risk as you trade. If the risk is too great, pass on the trade. Did this lesson teach you how to find support and resistance? Did this lesson teach you how to draw an inner, outer, and long-term trend line in an up and down trend? Did this lesson teach you that your trend is your friend until it bends? Did this lesson teach you that when the market bends and breaks a trend line, it is entering into the buy or sell zone? Did this lesson teach you how to place an order in the buy and sell zone and where to place your protective stop loss orders and financially protect yourself in every trade? If this lesson did not achieve this, then please go back and replay this lesson so that you clearly understand how to trade the buy and sell zone. Because of this reality that 90% of most novice traders fail, and because this is a zero-sum game to where losers pay winners, successful traders are successful because they have taken the time to properly educate themselves. That's usually what unsuccessful traders won't do. They won't educate themselves. They won't practice. They will not learn how the market works. They try hard to become lucky. And there's only two ways to pay for your education. One is luck. If you make money from trading and don't know what you are doing, you just got lucky. And if you just got lucky, it'll only be a matter of time that you will become unlucky and you'll end up losing all the money you made. If you have to be told where to get in, you'll have to be told where to get out. That is a very vulnerable feeling. The second way to make money is this: mentorship. Working with a mentor and getting an education on how the market works. It could be like buying a map to a gold mine. You learn where to get in and why, and you learn where to get out and why. If I said there's gold in them there hills over there, there's two ways to go extract that gold. One is to just go over there and try to kick over every rock you can and try to find the gold. Hopefully you'll come across within the next year or 5 years a vein that'll lead you to the mother lode, but I'll tell you, you'll save a lot of time, effort, and energy by buying yourself a map. Being mentored and learning how to trade, educating yourself before you go in the market is a lot like buying a map to where at least the vein starts that hopefully can lead you to the mother lode. Whenever a man or a person with money, and we have a tendency to think that just because we have money, we're just intelligence. The fact you have money does not make you brilliant, it just means you have money. Whenever a man with, or whenever a person with money goes up against a person with experience, at the end of the event, the man with the experience ends up with the money, and the man with the money ends up with the experience. Don't underestimate that little adage there. Let's face the facts. Every trader wants the market to move in their direction from entry. I showed you in this lesson that by understanding the buy and sell zone and educating yourself on the buy and sell zone, how the market can move in your direction from the beginning. There's 16 lessons on trading the Forex that can help you not only on the Forex but on a variety of products. These lessons are predominantly on technical analysis. They come with trading exercises that can sharpen your skills. You need to have a trader's mantra, which is that you will educate yourself before you trade. Your mantra should be, I will educate myself on how the market works. I will learn how to find and place a trade. I will trade with equity management. I will never trade without a protective stop loss order. I will not chase this market. I will be patient. And if the market does not meet my criteria, then I will not trade. Remember, if this chart is not clear and doesn't visually make sense when it's time to trade, when in doubt, stay out. Please adopt that statement. When in doubt, stay out. The 21-day 3% rule, until you get the buy and sell zones down clearly and they become a part of your trading habit, then play this lesson over and over again until you get it. The mind forgets 80% of what it learns in 3 days. If you play this and you don't replay it and have it become a part of your trading methodology, then you will forget it. Our focus is to have you at 85 to 95% recall when it's time for you to open up your trading account, allowing you success. A lot of traders end up buying these lessons, playing them once, think they know it all. Real life intervenes. 30 days later, they say, oh, I need to open up my trading account. Then they go open up their trading account. Think about it. 30 days later, they open up their trading account, and all they're doing is retaining 3% of everything they've been taught. You tell me, what rate of success will they have at trading? We would like to thank you for investing in yourself and purchasing this lesson. On behalf of everybody at Market Traders Institute Incorporated, at ForexTips.com Incorporated, we would like to say thank you. Your family and your financial portfolio thanks you for investing in yourself before you trade.